Are you ready to take your investing game to the next level? Investing can be a thrilling journey that can lead to significant wealth creation, but it's not without its challenges. In this video, we're going to explore the 5 most common investing mistakes that can hold you back from achieving your financial goals. Whether you're a beginner or a seasoned investor, these mistakes can have a significant impact on your investment returns. So buckle up and get ready to learn how to avoid these mistakes and become a more successful investor. Hello and welcome back to my channel. If you're new here, make sure to subscribe and hit the notification bell so you don't miss out on any of our future videos. Mistake number 1. Not diversifying your portfolio. The first mistake to avoid is not diversifying your portfolio. This means investing all your money in just one stock or sector. If that stock or sector experiences a downturn, your entire portfolio will suffer. To avoid this mistake, it's essential to diversify your portfolio by investing in different stocks, bonds, and other assets such as real estate or commodities. This helps spread your risk and reduce the impact of any single investment on your portfolio. Mistake number 2. Chasing after hot stocks. The second mistake to avoid is chasing after hot stocks. It's tempting to invest in a stock that's been performing well recently, but that doesn't always guarantee future success. Instead of chasing after hot stocks, it's important to focus on a company's long-term growth prospects and fundamentals such as earnings, revenue, and cash flow. This will help you identify undervalued companies with strong growth potential. Mistake number 3. Investing without a plan. The third mistake to avoid is investing without a plan. Many people invest without setting specific goals or timelines, which can lead to impulsive decisions and emotional reactions to market movements. To avoid this mistake, it's important to set clear investment goals such as saving for retirement or buying a house, and establish a long-term investment plan. This will help you stay focused and disciplined in your investment decisions. Mistake number 4. Ignoring fees and expenses. The fourth mistake to avoid is ignoring fees and expenses. Many people overlook the fees and expenses associated with their investments, such as brokerage fee or management fees. These expenses can eat into your returns and reduce your overall investment performance. To avoid this mistake, it's important to understand the fees and expenses associated with your investments and look for low-cost investment options. Mistake number 5. Being too reactive to market volatility. The fifth and final mistake to avoid is being too reactive to market volatility. It's easy to panic and sell off your investments during market downturn, but this can lead to significant losses and missed opportunities. Instead of reacting to short-term market movements, it's important to stay focused on your long-term investment goals and maintain a diversified portfolio. This will help you weather short-term market volatility and benefit from long-term growth. That wraps up our discussion on the 5 most common investment mistakes to avoid. By diversifying your portfolio, focusing on fundamentals, investing with a plan, being aware on fees and expenses, and staying disciplined during market volatility, you can become a successful investor. Thanks for watching, and I'll see you in the next video. Remember, investing is a long-term game, and it's important to have patience and discipline.